there are a number of paradoxes within the presentation that the Federal Reserve did this morning. The first paradox is the difference between the Fed statement and the summary of economic projections. The second paradox is within the summary of economic projections themselves. There are several parts of this that simply don't agree with each other. And so I was very puzzled when I looked at this morning was to work out why that is. So if we look at the statement that was issued by the Federal Reserve, and the crucial part is the committee does not expect it will be able to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. And in addition, the committee will continue reducing its selling of Treasury securities and agency debt and agency mortgage-backed securities as described in previous announced plans. So, firstly, what that suggests is that the Fed is in fact hesitant about cutting rates, but it's going to continue quantitative tightening. And it's only going to ease rates if it believes that inflation will fall. Which brings us to the summary of economic projections. Now, what we've got here is a set of forecasts that growth in the US economy is going to continue at 2%. And yet, in the circumstance where we've got pretty strong growth in terms of the long-term average growth rate in the US economy of 1.8%, inflation is going to fall. And that fall in inflation is going to be enough to justify very significant cuts in the real rate. So GDP this year is supposed to grow at 2.1%. I can tell you that's a lot higher than the current consensus. Growth next year is 2%. Growth the year after that in the summary of economic projections is 2%. And what's interesting about that is it's higher than the long-run growth rate of 1.8%. Now, usually what has to happen is you've got to get the growth rate of the US economy lower than the long-term growth rate to allow unemployment to rise to put downward pressure on inflation. So how come we can get these increase in unemployment and fall in inflation without that slowdown happening? How come we can get the effect of a slowdown and still we're growing at 2% or better? Unemployment in the outlook rises from 4% now to 4.1% next year, and then stabilises at 4%. In the longer run, it's 4.1%. So there isn't really much increase in unemployment at all. But PCE inflation falls from 2.4 to 2.4% this year, 2% next year, and 2% the year after, and then stays 2% forever. And core inflation pretty much does the same, or it does even better, because it's falling from 2.6% this year to 2.2% next year and 2% after. And if you can achieve all those things, which are counterintuitive, then what you can do is do what the Fed suggests in terms of rate cuts. 3 rate cuts this year, 3 rate cuts next year, 3 rate cuts the year after that, and 2 rate cuts the year after that. Now, some of those rate cuts are definitely going to happen, but in the long term, the continuing rate cuts, which reduce the Fed funds rate to much below 4%, are just not going to happen. And they're not going to happen because the increasing size of the US budget deficit means that the high level of debt and the rising level of debt, which will continue to rise between now and 2028, will increase the real short rate. And the real short rate will keep the Fed funds rates from falling below around about 4%. And our model, which we show in the quarterly, the equilibrium Fed funds rate is 3.8%. But that does mean that you can get, before that happens, which is in a couple of years' time, when you get down to that, challenging that 4% or trying to go lower, you are going to have a couple of years of easing Fed funds rate. Now, during question time in the news conference after the presentation, Jay Powell was able to explain why there is this difference between the short-term outlook for the US economy and the long-term outlook for the US economy. And what he said was it was improvement in the supply chains and improvement in the labour market, that the labour market in the United States had been damaged by the pandemic. A whole bunch of people stopped working because they were too frightened that if they went back to work, they would get COVID. Simple as that. Now, those people are now coming back to work, and that means the domestic supply of labour is increasing. In addition to that, he said there's an increase in immigration. So those combinations of the supply, people going back to work in the US economy, plus immigration, is increasing the labour market. And that's why you've got this increasing labour supply, which is driving down wages in a situation where unemployment is still relatively low. That's how that can happen. And in addition to that, he talked about the improvement in the supply chains. So he said growth is solid to strong, the labour market is strong, and we've seen core inflation come down. But now, he noted, we are approaching the base of the labour market growth, and labour market growth will slow. So the summary, the Fed statement doesn't predict cuts in rates, but the economic projections of members of the Fed who are part of the Open Market Committee suggested that their consensus is that rates will fall. We think it's reasonable for the Fed to cut rates 3 times this year. When they do so, by the way, they will still be higher than the Australian cash rate. The Fed funds rate will still be 25 basis points higher than the Australian cash rate if they cut 3 times. And we do think it's possible for there to be 3 rate cuts next year, but we think in 2025, but we think that that's where it all runs out because you run into the wall of attempting to finance an increasing US budget deficit. So in summary, the Fed made a relatively tough statement. The summary of economic projections suggests, however, that the Fed will ease off by the end of the year and the year afterwards. But after that, this is going to be good news for markets this year and next year. After that, I think a lot more work needs to be done on improving the debt structure of the US economy.